take positions in the market, set allocations for a very long term. And I think the best way of doing this is using index funds and exchange traded funds. So you're not predicting, you're not doing market timing or sector rotation. You're doing a set asset allocation based on your needs, and you're rebalancing every year back to that asset allocation using index funds and ETFs. That, to me, is what I'm trying to get across as a passive portfolio.
So when you refer to passive investing, you mean both passive in terms of security selection as well as asset allocation?
That's correct. Some people say that rebalancing is an active strategy, and I don't want to debate the minutia of it all. But,
it might be.
But it's not predicting. All you're doing is get everything back to what your needs are, what your asset allocation should be based on your situation, and I don't consider that active management.
That active investing strategies that try to beat the market typically fail to do so, at least for the majority of investors who engage in them.
Yes.
Give us a little background on why you think that is. Why is it so difficult for the average investor to outperform by selecting an actively managed fund?
Well, why I think that is because I went all the way back to the 1930s and looked at every single academic study done on active versus passive. Mm-hmm. And it's not me, it's just counting heads. Mm-hmm. And when you start counting heads, you realize that the ones that survive, because a lot of these active managers, the rotation, they come out, they might shoot like a rising star, shooting star, and then they fizzle out. So you have an awful lot of turnover of active managers. But even the ones who survive, only about 1/3 actually outperform, and they don't outperform by very much compared to the ones that underperform. And I'm talking about all indexes too. I'm not just talking about U.S. equity market.
No, that's an interesting comment, because oftentimes I've heard it said that in things like the U.S. equity market, say that the stocks in the S&P 500, which is obviously a big cap index concentrated in the U.S., for that segment of the market, indexation may be okay, but for less efficient parts of the market, say small cap U.S. stocks or international stocks or emerging markets, that's where active management can add value. Is that valid in the data?
No, it's not valid at all. I mean, it doesn't matter what asset class you look at. The active managers who survive, only about 1/3 outperform, and they don't outperform by very much or not for very long. So it really doesn't matter what asset class you're looking at. I think the biggest problem is not using the right benchmarks for these active managers. And then it looks or it appears that they might be outperforming when they're really not. So you have to have the right benchmark.
A good point.
Managers who did well, the top quartile versus second, third, or fourth, and we see how they did in the next period. So if you had 3 years where managers outperformed, how did they do over the next 3 years or the next 5 years? And it's almost completely random. It's a random event. Right. Past performance is not an indication of future results.
Yeah, that's the sense in which I suppose, and coming back to the statement in your preface, that you may buy a fund because it's done well, and of course the natural assumption that many investors make is that past performance does predict future performance, and what you're saying is that both the data and the theory say that isn't true.
It is actually, there is some theory data that is true, and that is that the worst performing funds tend to be the ones that go out of business. Mm-hmm. And that is fairly persistent. About 50% of the funds in the bottom quartiles are not around 5 years from now. So what happens is they might be in the top, they fall down to the bottom, and then they go away. And there's this rotation of active funds that take place.
Mm-hmm. And you come back to the 1/3, 2/3.
1/3, 2/3.
Yeah, well, considering that I can do 50% by flipping a coin, that's a daunting set of odds.
Well, the other problem is that the outperformance isn't by very much compared to the underperformance.
Right.
If you're going to go to the next iteration and you're going to say, well, 1/3 outperform, 2/3 underperform. If the outperformers outperform by a lot, then it's still
a fair bet.
Maybe a fair bet. The problem is they only outperform by about 1/3 of what they need to outperform by to make it a fair bet. So there's not that many that outperform, and the ones that do don't outperform by very much. So it's not a fair game.
Exactly. Given the strength of the case for passive investing, why do so few people do it relative to the universe of both financial advisors and individuals? I mean, you kind of look at that. I mean,
it's a beautiful city. Beautiful city.
Me,
somebody has to pay for this city. It's like going to Vegas. Somebody has to pay for those lights.
Is there? I suppose one might argue that the urge to try to do better than average is so strong that it overcomes the statistics.
Yeah, in fact, Mir Statman just came out with a book, What Investors Want, and in the book, Mir talks about the utilitarian benefits of investing, which is simply to get to your financial objectives, which is what the power of passive investing is all about. But people also invest for emotional reasons, for social reasons. Just the mention of the fact that you own a hedge fund says something.
Yes.
You don't even have to say what fund it is.
Yeah.
It puts you in a different group of people.
I'm accredited.
Right, and you go to the club and you start talking about the stocks that you bought that outperformed. Of course, you never mention the ones that didn't outperform. But so there's much more to investing than just a utilitarian benefit of getting you where you need to go. I argue that, fine, take a little bit of money, bingo money, and go play the market. Most of your money should be in this type of portfolio.
Exactly. Your advisory business is obviously built around passive investing. I mean, to the advisors who are listening now, who might be thinking about shifting from their active strategies or incorporating passive vehicles into their strategies, what advice could you give them?
Well, a lot of people are doing that. A lot of advisors are shifting to index funds and ETFs. The problem is they're trying to do market timing and sector rotation, and that doesn't work. That actually reduces return. So if you're going to switch to indexing and passive investing, just do a buy, hold, and rebalance strategy.
We've had the pleasure of talking to Rick Ferri, the author of The Power of Passive Investing, and we thank him again for being here.